You're listening to the Wealth Mindset Show, where Hicks and Zerker Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey. Welcome back to the Wealth Mindset Show, where the Hicks and Zerker team helps you manage wealth, navigate retirement, and make smart decisions for a secure, meaningful future. I'm Austin Wilson, Director of Investments at Hicks and Zerker Capital Management.
I'm Josh Robb, Director of Wealth Management at Hicks and Zerker Capital Management. Today we have Jordan Shaw and Chase Rose joining us for a discussion on how debt can destroy your future. So we're going to be talking about debt, its uses, whether it's good or bad, and all things. And we have some people here that have opinions. So it should be a good conversation.
So before we get started,
Yes.
what's going on?
Yeah. Well,
It's fall.
yeah.
It's hot.
I'll say I just got back from, my wife and I took an Alaskan cruise for our 20-year anniversary. And if you have never been to Alaska before, it's a beautiful state to visit. So saw a lot of wildlife and mountains and glaciers and all the things that doesn't exist here in Ohio. So
Correct.
It was pretty sweet to see. So I just say if you get the opportunity, it is a very unique world up there in Alaska.
I heard Vladimir Putin was there.
He was, I mean, you could, with my binoculars,
Were you guys there at the same
scout him
time?
out, see
It
where
was
he's
like,
at.
Hey, Vlad.
So-
You're watching me. I'm watching you.
Yeah, we were not there at the same time that he was visiting. So
Chase, the Dairy Whip's closed.
Dairy Whip is closed, not for the wrong reasons. For the right
For the
reasons.
for the
season.
season,
For the season, yep.
again,
So,
here in Ohio, there's
Yeah.
only a
Yeah, ice cream
limited time.
season's in the summer.
yes.
Go
So
to
my
Alaska.
wife gets a much needed break, and we both now have weekends.
Yeah.
So, yeah, this is our first weekend away from the Dairy Whip.
There you
So I'm
go.
excited.
Jordan,
Jordan just living life.
living life.
Tell them how you really feel.
Yeah, that's right.
Yeah. I'm a little backed up this week with my plumbing
Yes,
at my house, to be clear.
home issues are always
Home
existing.
issues. It's constant, but yeah, we'll get it fixed.
Old houses.
Old houses, 100 years old. Plumbing's
Yeah.
probably 100 years old.
Yeah, you've scared me out of living in an old house. I'm deciding to move away from you
Yep.
and live across the street.
Yep.
We had the same, it wasn't rocks like you found in yours, but we had the same thing. Ours were clogged and our home was only about 15 years old. So,
Yeah.
yep, it's just pipes
The
and
pipes.
tree roots.
Yep.
Pipes
those are
and
always
tree
the
roots.
issue.
Worst time. Yep.
So, debt. First of all, I want to say this episode was inspired by one of our other advisors, Jessica Hinks, also known as the Everyday Advisor. This is a blog she wrote, this whole idea of discussing debt in this way. So we'll link that in the show notes. Check that blog out. It's excellent. But she has some great other blogs on debt, financial freedom, all kinds of different topics. So be sure to go subscribe to that. But let's just talk about debt. A lot of
Mhm.
people have a lot of opinions on debt, depending on who you listen to on the internet. They can be, what's the Kiyosaki guy who loves debt so much. He's like, I'll take on as much debt as I can as long as it earns what I need it to earn. And then you've got Dave Ramsey on the other side of the coin. These are both roughly billionaires. And he's saying, I will avoid it like the plague, not even a credit card that I pay off every month. Right. So those are the two ends of the spectrum. Where's the truth?
Somewhere in the middle.
Somewhere in the middle. Josh is going to say it depends or
Yes.
in moderation or something like that.
All the time.
That's what he always does. But
That's
there's
a safe answer. We're here to be bold today.
I know.
Josh.
Well, we're going to get bold.
Safe and right could be the same thing.
That could be. So let's talk about a couple categories of debt. The first being consumer debt.
Yes.
Because there are other kinds of debt that we're going to get to, which may be better. But consumer debt, generally speaking, not favored. Josh, talk a little bit about consumer debt.
Yeah. So, consumer debt, those are us, right? We're the consumer, we're purchasing. So purchasing debt, you're buying things. So a lot of times debt, we should probably define debt is when you purchase something and you don't have the money at that point, or maybe you have the money, but you don't want to use your money.
Yep.
So you borrow from someone else and you have an obligation to repay that borrowed money.
Yeah.
That's what debt is. Most of the time it will come with some sort of interest because the person lending you money wants to earn something for not having that money available. So the interest is what you pay on top of what you borrowed.
And they're taking risk.
They're
They want
taking risk
compensated for
because
the
they don't have
risk.
the money. Yes. So that's debt to begin with. So consumer debt is I bought something. I bought a TV. I bought a car. I bought a house, something. And I said, I either don't have the money or I don't want to spend my money. So I'm borrowing it from somewhere else.
Exactly.
You mentioned credit cards.
That's one.
There's, mortgages
Yeah.
are a form of debt, car loans. You can get home equity line of
personal
credits,
loans.
personal loans, all different ways of getting money. And the reason why they can be a problem is consumer debt has interest. Almost all consumer debt. We had some very low interest rates for a little while where there were some 0% interest rate debt, which we'll talk about in a little bit. But I'm going to use the general assumption that most consumer debt carries interest.
True.
So it's going to cost you more for the thing you're buying than if you would have just paid cash for it. So that's one thing that can be an issue for it. Yeah.
And another component of debt in general is that it's instead of saving up as you want and as you can to buy something in a chunk of cash, like you're laying out a bunch of money or however you're paying it off all at once, you are locked in for a long period of time at paying some chunk of that, right? So it gives you a little less flexibility because you're continuing to have payments.
Yeah, and your income now has an obligation to
Correct.
it. Whereas before you had that debt, what money you came in, it was your choice what you wanted to spend on it. But once you have debt, you have to make those payments. And so less of your income is available for you to make other choices with. And then along with that too, over that time frame, things could happen. Your income could change. You still have that obligation you have to pay off. So those are the consumer debt issues people deal with. And they can compound. They can add to it. If I have a car debt and then I get a house, now I have a car debt and a mortgage. And so now I have two obligations. So your debt obligations can continue to grow.
Absolutely. And this can be a risk for people with careers. And this is definitely, I would say, even more of a risk for people without a
steady income,
right? That's where things get in trouble. So what do you guys think about consumer debt?
I echo everything you guys are saying. Consumer debt in general, you say it limits the flexibility. Yeah, when it's a matter of the two options of paying up front or some limited flexibility of paying down the road, if you can't afford it, then don't pay at all. But if you can afford it, pay up front. I don't know.
Yeah, I think we all agree with that. If you can't afford, well, a rule of thumb I always have, with the exception of, I guess, large purchases, so like in excess of 5 digits. With the exception of that, if you can't afford to purchase something outright with cash, you should never finance it in the first place, right? Like I said, cars can be an exception. Homes are certainly an exception because not everyone has that kind of cash sitting around. But no, I reiterate that point. I've always had the perspective. I'm open-minded on consumer debt for one specific reason. If you truly believe that you can earn a higher yield than what you're paying in interest elsewhere, that's where I would be open to considering consumer debt. But unless that is the case, I am just like all you guys, anti-consumer debt, if possible.
Yeah, I had the opportunity to do a 0% on something a while back when that was available. I had the money. I could have written a check for it, but I was earning more in interest than I was on 0% financing. So I left the money in my high yield savings account, had 0% interest, knowing at any point in time I could just use that money and pay it off. But I ended up making money over that 3-year time frame. I had the 0% financing.
Yeah,
absolutely.
But yes, you're right. It's instant gratification. It's people who say, I really want this now, and I'm not willing to work and save the money to get it. And that's the trade-off. And most people who run into debt issues struggle a lot with this idea of delaying that gratification until I can actually afford it. And it's more of a habit and kind of that mindset and willpower than it is a spending issue in a lot of situations.
Yeah, it also keeps you in survival mode, right? So when you take on, so like your example, you have a mortgage, then you bought a car on a loan, then you have a credit card payment that like you're not paying off every month, so you have an ongoing payment there. You just are looking at things with, oh, well, I can afford this payment because my income's this, not I can afford the whole thing, like Chase said, and then just using that as a way to, or rewards or interest or however you want to do. So it kind of keeps you in survival mode, and it just limits your flexibility, right? We like flexibility when it comes to finance. So here's where we're going to get maybe controversial.
Okay.
I like controversy. This is going to be a good topic here. We're going to talk about good or okay. We could say maybe tolerable debt and maybe not so good debt that we would avoid at all costs, right? So first example, mortgages. Who here paid for their first couple houses with cash?
Nope.
Oh, okay. So I guess the financial people in the room would say that mortgages may be okay. That might be an okay form of debt. Now, why would that be, Chase?
Well, I would actually expand this to say that purchasing an asset that historically does not depreciate. Now, houses have depreciated.
Yeah, oh, yeah.
They
Certain
fluctuate,
periods.
but over the long
Take
period.
the GFC out of
Yes,
the picture.
purchasing assets such as real estate, if you're an aggressive investor and you finance a business purchase as
Yeah.
opposed to just starting your own, that is a tolerable debt. It's something that can and will appreciate, provide income, all
Yeah.
the things that you can use to pay that debt off. And that's the biggest thing is, when you end up paying, let's just say you have a 30-year mortgage and you pay this mortgage off. Yeah, you spent 30 years making payments. You probably paid a good amount of interest during the term of that loan. But when you're done, you have this asset that hopefully has appreciated in
Mhm.
value that is worth something to, if you want to sell it someday or,
Right.
or, downsize or upgrade or something along those lines. So that's why I personally am fine with mortgages. There's always the big analysis that a lot of clients ask us, should I pay off my mortgage or should I keep the money in my retirement portfolio?
I bet Josh has a
And-
great answer for that.
Guess what? It really depends on your situation.
Exactly. And most often, especially coming out of the whole 2020 area where, interest rates were so low, more often than not, the answer is to keep the money in your portfolio because historically it's
Yeah.
going to earn
You
more
have
than
a
what you're paying.
2.5% mortgage
Yeah.
rate, and you've historically grown your account by 5.
Right.
Yeah, keep the money invested. And
Exactly.
continue to pay that.
But that
2.5%.
is only one part of the equation. What a lot of people don't like is the psychological aspect of
Yeah.
just carrying debt in retirement or even not in retirement.
And I actually have heard that someone, maybe it was a Dave Ramsey thing. And now we got to be careful because I just mentioned earlier, he is like the most anti-debt human alive, maybe next to Jordan. And
Possibly.
so therefore, take that all with a grain of salt. But he said he's never talked to someone who regretted paying off their house early.
Sure. I would say
And I
that's
guess
true.
from a psychological
Yeah.
standpoint, that makes sense because you pay off your house regardless of what the math will say. We
Yeah.
know what the math says. You have no payment, right? You can do what you want. You're
Yeah.
freedom. You're not
I
tied
would
to that
agree with
payment
that.
every
Yeah,
month.
there are people who understand the numbers and are okay with keeping that debt, like Chase was saying.
Yeah.
But those that do pay it off early,
They don't
they don't
regret
end up regretting it. They don't.
It gives
Even when
peace
they
of
look at
mind.
it, oh, look, I could have grown it.
Couple
They
more
still
percent.
grew everything else at that rate, and they were debt free. So yeah, I would agree. No one regrets it, and that's not a bad decision. But between the two,
Yeah.
the numbers tell you that more growth, keeping more assets in the higher growth thing is a better deal.
So guidelines
Yeah.
on mortgages. Commonly in America, so we're speaking to Americans. If you're an international listener, thank you for listening. But we do our mortgages a little bit different here.
Yeah.
We have other options, but most people get either a 15 or a 30-year fixed rate mortgage.
Yep.
Those are by and large the most common things that we see. We would say if you can, put 20% down. If you can't, put at least 5 down.
Yep.
If you get 20%, you avoid, private mortgage
Mhm.
insurance, which is a nice additional fee that you'd pay every month in terms of insuring your
Yep.
mortgage because you don't have a lot of equity in the home. But ideally 20, at least 5. A lot of people on the front end when they're younger, probably doing about 5. And then look at your payment, right? This is where you have that $300,000 house. You can back into what's a 15-year payment look like? What's a 30-year payment look like? Try to get that under 30% of your gross income. And these numbers can move a little bit depending on who you are, what your income looks like, but that's kind of a general rule of thumb, and that's including things like taxes and insurance and all these things. So
Yeah, that 30% number is the key. If you're just looking to buy a home and you're looking, what's my budget? The industry says that 30% is kind of that threshold.
Right.
And that's your all in, like you said, your all in number.
Yeah.
The property tax, insurance, and mortgage payment. That number needs to be below 30% of your gross take home pay.
And I think we live in a world where houses are very, very, very expensive now compared to where they ever have been. They've just, and then it's not, usually houses appreciate by an average of about 3% per year, right? But since COVID, things have appreciated at like double-digit rates, and the whole market's very, very different. So it's very hard for some people to find that as an option.
Yes.
So one thing you can do is delay that buying that house a
Yep.
year or two to save a little bit more and have a little bit more down payment to make yourself more comfortable, or your income would grow. But we would just caution against buying too much house that it makes you house poor.
That's the biggest thing is it's a big asset. It's not guaranteed to sell quickly.
Yeah.
And if you're stuck with payments and you can't make them, losing that asset is not a great situation to be in. And so you never want to extend yourself with the idea that I'll eventually be okay with this.
Yeah.
And that's what we saw in 2008, 2009, and that housing crisis that happened then. A lot of people bought a home thinking they could quickly sell it And when they couldn't make the payments and no one wanted to buy it, there was a lot of issues.
Yep.
So don't think that, these payments, it'll be hard, but I'll eventually be okay. You can't count on raises. You can't count on appreciating house, all those things, lowering interest rates. Some people say, well, I'll buy it now because interest rates are going down. We don't know. It's not guaranteed. So don't overpay for a home. Make sure you can afford it today with where you're at.
Exactly. So, guys, thoughts on mortgages?
Yeah, real quick with that, the whole 30% thing.
Yes.
I believe that 30% is a max and also should include other expenses that come with the home.
Right.
You should, if you're looking at 30% of your gross income, gross household income, and maybe that should even be smaller if you've got more people under that roof, because more variables, more things that could go wrong in personal lives, and then things that could go wrong with the house that you know, depending on how old the house is, things go wrong and then you have to dip into savings. And that should all be part of that 30% of your income, because if 30% is just your mortgage, you're going to outdo that really quickly with home repairs and things that can come up.
For sure.
So another topic, car loans. As Chase alluded to earlier, this is kind of over the category where it's oftentimes hard to have this much cash on hand because cars, just like houses, more expensive than ever. In fact, I was writing a blog post recently and I looked up the value of the average new car, or the cost of an average new car, $48,000. That's a lot. Like, I remember, I mean, maybe I'm aging myself now, but I was like, oh yeah, cars are $25,000. Cars are not $25,000 even. So not many people have 50 grand laying around to go buy a new car. And that's an average, right? There are so many cars above that and some cars below that, but 48 is kind of an average. So car loans, a lot of people use them. A lot of people take on a car loan. This is a loan that is secured by the car. They will come take your car if you don't make the payment. And of course, there's interest involved with that. These loan terms, typically a lot shorter than houses. We're talking 2, 3, 4, 5. Now they're getting up to 6, 7, and 8. We would not recommend going that long, but they are. So when you think about that, what do you guys think about car payments?
Yeah, cars are definitely I would consider cars being a category of their own, because not often, outside of just simply putting, balances on a credit card, not often are you, if you're taking a car loan out, not often are you purchasing an asset, because it's technically an asset that depreciates as quickly as vehicles do.
Correct.
If you buy most other assets, if you finance, let's say you buy a nice watch, like that watch is not going to depreciate like a car does. If you buy a home, your home typically appreciates. So cars are definitely in their own category. But I can't remember, and I feel bad that I'm not going to be able to give the right person this reference, but I heard someone say one time, you're either saving up for your next car or you're paying off the one you have, right? So I've kind of taken that into perspective, and I'm less against car payments as I used to be. However, if you feel like you need to get into the situation where you're extending the term of that loan to afford the car, that should absolutely not happen.
Right.
My own rule of thumb for it's same with mortgages, as we talked about earlier. If you can't afford to put 20% down on a car, you probably shouldn't buy that car.
Right.
If you can't afford to pay that car off at 5 years at the max, you probably should not buy that car.
How long do you own a car? You don't need to get an 8-year loan if you don't think you're going to have that car in 8 years.
Yeah,
exactly.
It's always crazy when someone sells a car they still owe money on.
Yeah.
I think it was like, then you have lots of banks involved, and it's really wild.
Yep.
I think that cars are interesting because, yes, they are a depreciating asset. So you're paying, for example, you buy the $48,000 car. You're paying interest on top of that, which, by the way, is more than a mortgage, interest rate wise, right? So you're paying 7, 8, 9, 10% on these car loans for 5, 6, 7 years a lot of times. So you're paying a lot more than the car's worth when it was new. But by the time you're done paying it off, it's worth 40% of what it was when it was new. So the math is not great for car loans. It's the same, I guess, when you look at used cars. Like financing a used car is the same thing. However, you typically do avoid a little bit of the depreciation hit. But the interest rates are higher, right? So, car loans, not ideal. That being said, I understand that people need to have safe and reliable vehicles to get to work. That's just a fact of life. But people will push back on me on this. But I know for $5,000, you can go get a used Honda or Toyota from 15 years ago that's still running great and get anywhere you need to in the continental U.S. for $5,000. So if don't say I can't afford a car, you can't afford a car. You just have too big of a pride issue.
Well, and I think that's where it comes down to for me is I think debt on a car is bad, but I think if you need a car to get income, to continue taking care of your family, getting out of debt and all those things, then maybe that has to happen. But you don't need to go buy a new car to do that.
Correct.
You may need to get a loan for a $10,000 car that's reliable and what you need. But that's getting out of a situation. It's not, hey, I'm doing pretty good, but here's this really nice car I want, like Chase was alluding to. If I can't afford it, just because I really want it doesn't mean I should finance it.
Right.
But you're right. When it comes to just straight up, hey, we had some life situations and I need a car and I don't have cash right now, this is the only option. But don't go out and get a brand new car.
No.
Go find something that the most reliable of what you can afford and go there. Because losing your income is the worst thing.
Oh, yeah.
And if you can't get to work to get the income, that just cascades everything else. And so that's the one spot where I've always said, why would you get a loan for a car? But there's situations where you need
a car.
But if you're just sitting there like, hey, I saw this ad for this new brand new car I really like. Oh, look at this. That's not the loan you should be looking for.
And typically, if I'm going car shopping right now, I'm shopping like a 2 to 3 year old car. The big chunk of depreciation is cut off already.
Yep.
So you still have a new and reliable car that's very low miles at that point, typically. So that's kind of the sweet spot that I found, and a lot of people I know do too. Jordan, any thoughts on cars before we move on?
Yeah.
Don't
do it. Ask Aunt Sue when her 2010 Subaru Outback is going to be moving on from her, and
work out a deal.
There you go.
Yeah.
Y'all get along.
There's a lot of times where, again, finding a nice used car that has miles on it, but is still going to get you where you need to go is the answer. Yeah. Right. A lot of people think that, they got to go get the new deal because there's better financing. No, get the cheaper car.
Yeah. I'm biased because I drive a really old Honda with almost 200,000 miles on it, but that's why I'm saying you can go find an old car that will still work fine. It'll need a thing here or there, but it's just fine. All right, this is the
Austin.
fun.
Vehicle interest is deductible now. Does that justify my
Only
purchase?
Didn't you do the math on that? It's like you have to buy $150,000 car to get to be able to take.
And it has to be assembled in the U.S.
We've mentioned that in a previous podcast episode.
Don't count on that.
Don't count on that.
Before we get back to today's topic, I wanted to take a quick moment to share something that could really help you on your retirement journey. At Hicks & Zerker Capital Management, we're all about making sure your financial life aligns with what truly matters to you. That's why we created the assessment, Are You Retirement Ready? It's over at hzcapital.com/quiz. It's a quick and easy quiz that helps you figure out how prepared you are for retirement. It only takes a few moments, and you might discover what you need to do before you retire, both in the financial and non-financial aspects. Head on over to the website and check it out. Again, that's at hzcapital.com/quiz. Now, let's jump back to our conversation.
All right, here's an easy one. Credit card debt, and I'm going to say credit card debt with interest rates.
Okay.
What do we think?
Credit card debt without interest rates. It's still bad.
Yeah,
my personal.
Yeah. I'm talking about, but we're going to talk about zero interest stuff here in a second. But credit cards typically have really high interest
20%.
rates. 20, 30, for 40% interest rates. Don't ever carry a balance.
Yeah.
Now, I am not with Dave Ramsey on the anti-credit card train, right?
Mm-hmm.
I use a credit card for every single purchase I can, and he will say that you use more psychologically, spend more if you have that. And I say, no, I'm cheap still with a credit card. But as long as you pay it off every single month, you can get some decent rewards, and I like my cash back. And that, I feel like, is arbitrage because they are saying, Austin, you're probably not going to pay this off, so here's some cash, right? Mm-hmm. And I'm saying, ha, 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 sucker.
And they're also getting money on the transaction. So they're, even for you, they're going to make money off of, and they're willing to pay you that cash back because they're making money on the transaction.
So I'm team have a good credit card with great rewards, use it all the time, pay it off every single month, never miss a payment, set up auto payments, and you'll never have an excuse.
There's safety built into credit cards that debit cards don't have when it comes to fraud and those fraudulent transactions because it's not money out of your bank account directly. Yeah. So I'm also a fan of credit cards if they're paid off every month. Correct. But credit card debt, if you're running into a tough situation, don't use your credit card. No. Find other ways because that's the worst debt to have when it comes to interest rates.
Think about the compounding interest on the wrong way, right? We let compound interest when it comes to growth. Well, you get compound interest when it comes to debt, and that 30%.
The wrong way.
That's bad.
Yeah.
Credit cards?
Good.
I actually like credit cards because of what you were saying with the points. with a lot of discipline, as you're saying. The auto pay works great. I'm going to take it a step further. I pay my credit cards off twice a month because I'm that terrified of one day being missed, even on an auto pay system with 28 days in the month of February. And how is it gonna? I'm insane about it because I don't want even a penny to be carried over. But I do like my Discover points at the end of the month, and with kids to feed, that's a meal right there.
Right,
so.
right.
Yeah. One thing I'll add, I think Josh, you mentioned it earlier, or maybe it was you also, I can't remember. Whoever, when you're swiping that card, that credit card company is charging a fee to whatever that point of sale system is. They're collecting a fee on that, right? If you are using a credit card, be mindful because almost all businesses are letting
Passing
you
that
know,
on.
by the way, if you use a
yeah.
credit card, we're going to charge you 3% more than what the actual cost is.
Yeah.
And so me personally, I carry a credit card with me and my wife does the same everywhere we go. But if that fee is posted, they're never going to pay you more cash back than what they're receiving on the other side.
Yeah.
So I always carry cash.
So on that, Chase, this is a pet peeve of mine. Small business owners around the world, build it into your price. Never put it on there as a line item. It makes you look cheap.
Even if you
I will
increase
never
your price for it.
Yeah, I will never complain if you build it into the price, and I will swipe my card. But if you put a line that says 3.5% or whatever, I am going to be like, you cheap, whatever you want to say.
Correct. But I would also say that if you build it into the price, you're collecting more than you probably should. Then you're increasing your margins at the expense of the customer. I say this
That's good business right there.
as a business owner.
It's marketing. It's all marketing.
Offer people the cash discount. Market as a discount, not a increase.
That's the
and
new way
that's
of doing
actually
it.
better.
Yeah.
It's
If you
not
pay
that these-
cash, we'll reduce it because they've already priced it in.
Yeah.
So
Yep.
Nothing
It's
peeves
both
me
things.
more than that line at the bottom. I'm like, really? You're charging me?
Don't be mad at the small business. Be mad at the credit card company.
Yeah.
It's
No,
not
as
the
a credit
business's
card
fault.
company shareholder, I love it.
Exactly.
Maybe my shareholder price increases and dividends will offset my expenses going.
There
to
you
credit
go,
card
maybe.
company. Yeah, exactly. All right, zero interest financing, the moment you've all been waiting for.
Mhm.
Where are we standing on that? And I'll go first.
Yes.
It depends.
There you go.
Yeah,
That's
I
why you
think-
wanted to go first.
I know. I on one hand, if I can get like Apple's, for example, you buy an iPhone, you can finance it over 24 months, zero interest, and you get like 3-5% on your Apple Card cash back on the iPhone by using your Apple Card. Like that seems like the math makes sense. That being said, I don't think you should.
Drop and break it into 24 months.
Yeah, that's a bad idea. 0% is okay sometimes. There's not a lot of 0% deals anymore. There was a long
There
period
used
where
to
those
be,
were very, very common. They were even common for cars.
Yeah.
Now we're starting to see some of those, but that's usually a sign that the economy's pretty weak when that happens. So yeah, I say it depends. I don't use them a lot, but I've done it for a phone here and there, and I could pay it off, but if I can get 5% or whatever on it, I will.
Yeah, I'm the same ways. If I'm already considering purchasing something and that's an option, I'll consider it as one of my options. So if I'm already done the math and I'm saying, okay, I'm buying whatever this thing is, and let's assume I had the cash to pay for it, I'll just say, do I want to set up an automatic payment and just have that stretch out for X amount of time or just pay it off? I'll consider those too, because
Right.
what can I do with that cash if I don't
Yeah.
use it right up front? So I'm open to 0% financing, but you have to have discipline.
Oh, yeah.
Because there's rules
Those
to that.
payments add up too.
Well, not only that, but if you miss it, most of the time they'll go back and grab all the missed interest, and then you're really stuck.
Yeah.
So
Yeah.
it's one of those, you got to be disciplined. You got to know and understand exactly what you're getting into. But to me, it's another tool of just being as smart as you can about purchasing something if it's an option there.
I'm going to have to say that I completely disagree.
Ooh,
Good.
I like it.
I knew we were.
Dissent.
Now, when we're looking at the math behind it, I don't have much in ways of arguing that. And I think looking at a spreadsheet and cold calculations, zero interest, of course, makes sense. I think we all would say I shouldn't be sitting around here with a team of financially minded people if I didn't say that. So where I have a big issue with this is because it is so blatantly preying on behavioral cues for people that are looking into this. Now, you mentioned that, if you've done all the research and you know that you're going to buy something going in, most people, when they see this, it's thrown out Why? Because the business wants to make whatever it is more attractive.
Yep.
So you're seeing this and you go, oh, okay, well, what am I getting for this zero interest? I wasn't planning on buying that nice watch, but they're practically paying me because I can get 3% in my savings account.
How could I afford not to?
How could I afford not to get this budget buster item, whatever it is, just because that zero interest finance sign is out there? So that is my biggest problem with it.
Yes.
And the other piece of it is, we've already talked about this a little bit prior, but if you're going in, you're saying, okay, I'm going to, I have the money, even if I do, have the money set aside, I'm going to go into a zero interest financing contract for whatever amount of years. If that money is still sitting in my bank account and then I have the nice watch on my wrist, there is a larger temptation to spend that money now that I've already spent. So it is harder to track and, like you said, discipline. Really, the behavior that goes into it is just, if there's something that you want to buy and there's the price tag, you're not losing anything, in my opinion. Write the check. You're not tempted to spend any more than you have. And if you have buyer's remorse, well, I shouldn't have gotten that nice watch. Or they just roped you in with that zero interest sign.
And you are absolutely right. It's all behavioral. And if you don't have that discipline, then you're right. That is a trap that, that's 0%. Oh, that's 0%. And maybe you've already double counted that money you have sitting aside to pay those things. You're right. That's the big one. Like my example, what my wife and I was some home furniture, and we were already going to buy it, and we had been saving up, but that was the option. Let's go for it. And that money, I just set up an auto payment to that account, and it was done. But you're right. You have to be disciplined, or else you're tempted to also use that money for something else. And I'll have more money in the future. It'll be fine.
I think what's
That's
crazy.
what you have to avoid.
What's crazy is you're starting to see this all over. You can see on Amazon, Klarna, spread this $100 thing over 4 payments. What? Why are you buying something for $100 if you're going to put 4 payments of $25? Like, that is the consumer side of things that I think it is taking advantage of people, because maybe they can only afford the $25 this month, and so, but they're going to buy it anyway, which is not good for them. And I think that that's a little bit sketchy. I saw a crazy example that was like, you can now, it was a food delivery app. It was like Uber Eats. You could spread your Uber Eats order with 0% interest over
gone,
like
and I'm still paying for
6 months or something like that. I'm like, come on, people.
As long as the time period only lasted as long as my heartburn, I would consider that.
That's right.
But if it's any longer than that, it's too long.
Well, with some things, that could be at least a day or two.
You know what?
Chase?
I'm fully on board with the behavioral side of things, and I'll touch on that in a second. I'm a left brain analysis paralysis type of guy, right? So when I run the numbers, almost always, if you have the cash available to make a purchase and 0% financing is an option, it makes sense to finance, not pay interest. Mathematically speaking, yes. But when we talk about 0% financing, the most common form of that, in my opinion, from what I see, is you have credit card companies who are offering you 0% APR on the first 12 months, 15 months, 0% on balance transfers, all that kind of stuff. And so the behavioral side is, I can spend more than I can pay off on my credit card this month because I'm not paying any interest for the next year. And then you do that the month after, and then you do it the month after that. And then all of a sudden, you have balance transferred your way through every credit card company on the market, and you have nowhere else to go. And then you are in a bad situation.
And you have to pay the piper.
Correct.
At some point.
Yes. So that is where I do not agree. I don't think zero interest financing is a good thing if you are carrying a balance like on spending that you didn't have to spend in the first place.
Correct.
So that's just the way to dig yourself in a hole.
And on those balance transfers, there's almost always a fee. It's usually a percentage. Sometimes it's a minimum, but they're getting paid. They're not paying interest right now, but they're getting paid somehow to transfer that. So just keep in mind, that's not something we would recommend. So
one more bone to pick with that too.
Like
if you have the option of the zero interest financing, whatever vendor you're going through, I would ask, if you're going to completely disregard everything that I have to say about it, I would at least ask, right? At least ask to see the comparison. What if I write you a check today? What if I zero interest finance? And see if it actually lines up, because there might be some other fees built into this that they're raising the price on the zero interest, and they're saying, okay, you're
not paying interest.
Your price up here is this, and then it's spreading out. But in reality, they're actually building in some of those other fees up front.
All right, so let's wrap this up by talking about action.
All right.
The action from this episode is, I don't know, take some debt on, don't take some debt on, do what you want. It's the Wild West, man. But no, for real, what do you guys think? What are the action steps here?
I think the first one is evaluate where you currently are.
Yeah.
Look at what current debts you have. What is the interest rate on those? And do I still believe those are good debts? So again, going back, looking at your mortgage, do I still think, again, we're on pretty much a good agreement here. That's an okay debt. Now, is the payment right? Because I bought this house before I heard about maybe not stretching myself too far, but evaluate all your debt and saying, am I still comfortable with all of these? And if not, create a plan to start reducing them. And there's different ways of doing that, which we've talked about in old episodes.
Yeah.
But that's the first step, in my opinion, is evaluate where you're at. What am I currently obligated to pay? And do I agree with still carrying those on?
Yep. What do you guys think?
You have a stronger opinion than I do, Jordan. You go ahead.
Yeah, I like that idea of, evaluating where you're at, seeing how it fits the budget. I think if there's anything out there that you are willing to go into debt for, and you can't afford it out of what you have, then it's not the right. The Lord isn't opening that window to you or that door to you, right? It's just a window that you're looking through and you don't actually
Yep.
have the ability
you're
to
forcing
go.
Contentment is a big thing to master.
Exactly.
If you can be content, you're going to be a lot happier of a person.
Yeah.
Chase, actions.
Yeah. So do the math first and foremost. Understand what your options are. But a life with no debt is freeing. Like
for sure.
The psychological benefits of not having that next bill coming up the next month is a great feeling. I wish I knew how that felt.
Yeah.
Because I'm just a young, just getting started. But through people that I've talked to, that is definitely the life that you want to work towards.
Mm-hmm.
So
yeah, I think overall there's a handful of types of debt I'm cool with in moderation.
Mm-hmm.
Things like a mortgage, things like a fixed rate mortgage. We're blessed in the United States to have fixed rate mortgages.
Yes.
Most places in the world do not.
Mm-hmm.
So that is something that historically has been very good and gives your family a very nice place to live, hopefully, better than most people would have.
Yes.
Another one is buy a piece of a growing business. I think that that's an okay use of debt. As long as it's fundamentally sound and run well and doing well, right? To know everything you can know about it before you buy it. It's the same way we would say about stocks.
Yes.
Exactly.
Yeah.
That's what you're doing. Do your research.
should I be buying stocks on margin?
No, don't get me started. That's another episode. And another one would be education.
Yeah.
I think that it is okay to take on student loans within reason. Like, I'm not talking about getting $100,000 of student loans for a basket weaving degree. But if you have a degree that can generate great income for you to provide for your family, for your life, that's worth.
It goes back to appreciating asset.
That's an investment.
Education increases your earning potential, which is increasing the long term. So that's a valuable debt to have.
Yeah.
And I also think there's a lot of pressure to enjoy the traditional college experience, whereas you can obtain a degree in a much more cost-effective manner than what society would say.
Totally.
Or based on what you want to do, you may not even need a degree. You may just need licensing or credentialing or even
trade
just
school
opportunities. So
absolutely. So that's kind of what I have to say. And otherwise, thank these guys for getting around the debt bush with us today. It's been fun. That was probably our rowdiest episode in a while.
Yeah,
so.
Go check out Jess's article, though.
It was really fantastic. Yes. So again, we'll link that in the show notes. If anything, sparked thoughts or helped you, understand debt or money a little bit better, hit that subscribe button on your podcast player. We'd love it if you'd continue to follow us as we put out these episodes every couple weeks, and check out our social media. We're pretty active on there, and we'd love to interact with you there. And you're always welcome to check out hzcapital.com. You can learn about our firm, Hickson Zerker Capital Management, and a little bit more about us. And maybe you have questions about your financial situation, so you can check out the Invest With Us tab there as well. Otherwise, thanks for listening, and we'll talk soon.
All right, talk to you later.
Bye.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hickson Zerker Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hickson Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hickson Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.